Think back to the time of your school when you practiced math problems. What did you do to check that your answer was correct, to make sure that you had not made a mistake? You probably checked your answer against the solution manual or asked your teacher or your parent or a sibling for some help. Do you show this level of commitment to correcting mistakes when thinking about your finances or while investing? Both of these are very important since your financial situation determines your standard of living in the future, which college your children go to, and how early and comfortably you retire. It is not as easy to identify and correct investing mistakes as it is to correct mistakes in math problems in school. There is no solution manual, and your parents or other people around you might be equally unaware when it comes to investing. The first one is the disposition effect, and the second one is recency bias. I will also talk about the psychological reasons behind these biases and suggest some potential techniques and strategies that can be used to reduce the effects of these biases. Let's talk about the disposition effect first. Imagine you are currently holding a stock in which you have a 40% profit. I'm sure you would be tempted to sell the stock and convert the profit into cash, or in other words, realize or book the profit. Let's say you do so. Now, what would you do with the money that you have just earned? Put it in another stock or a fixed deposit, or spend it on a new iPhone perhaps? Whatever you choose to do, I'm sure one thing that happens is that unless it's a stock that you closely monitor, you end up forgetting about the stock that you had just sold entirely. But what if that stock is actually better than any other replacement stock that you buy? Turns out this happens quite often. Decades of academic research has shown that investors consistently sell stocks that are actually better than the stocks in their portfolio. This means that they are selling good stocks and holding on to bad stocks. They would be a lot richer if they do the opposite, which means that they sell bad stocks and hold on to good stocks. This tendency is known as the disposition effect. One of the main reasons behind the disposition effect is that people enjoy realizing a profit but really dislike realizing a loss. Booking a profit makes a person feel good about themselves, makes them feel like they are a good investor who can earn profits. Booking a loss does the exact opposite. It makes them feel like a bad investor because it means that they have to admit that they made a mistake in the past. After all, which good investor makes losses? So they hold on to the losing stock, convincing themselves that the tide will turn and they will sell this loss-making stock when there is a net profit or at least no net loss. Now that you know about the disposition effect, you might ask, how can one identify whether a stock is good or bad? This is a difficult question to answer and unfortunately not one that I can help you with. However, it might be easier to identify times when you're selling or choosing not to sell a stock due to the disposition effect. So how can you do so? Firstly, when you're thinking about the performance of a stock, you should not just think in terms of absolute profit or loss that you see on your broker's app. Rather, you should compare the stock's percentage profit to the profit or loss earned by the market index, such as Nifty 50 or Sensex, in the same holding period. This is because you could have earned at least this amount by investing in the index without much additional thought or effort. Stocks that earn returns well below the market index for a long period of time, let's say 10 or so years, might not be very good investments. Secondly, when you're thinking about selling a stock to book profits, think seriously about where you will be putting this money. Will you be putting it in another stock or another investment? If so, do you think this new investment is going to be better than the stock that you're selling? You should sell the stock only if you think the new opportunity is better, or if you want to use the money to buy something you need. If the only reason for you to sell the stock is to book profits, you should probably hold on to the stock if it is a good long-term investment. On the other side of the coin, you should routinely try to look at the stocks in your portfolio that are making a loss. Are you clinging on to these stocks because of a false hope that they will bounce back? Are they fundamentally good stocks? What are the reasons that you're invested in these stocks? If you struggle to find good reasons about why these stocks are fundamentally good and will earn you more profits in the future than the market, you should probably swallow your pride and sell these stocks and put the money in a Nifty 50 or Sensex index fund. Another technique that you can use to avoid the disposition effect is to mainly invest in funds. There should be less hesitation in selling loss-making funds because, after all, if the funds are making a loss, it's the fund manager who's the bad investor, not you. Another important bias is the recency bias. While the disposition effect is about selling decisions, the recency bias is more related to the buying decision. In this bias, people observe prices going in a certain direction. Let's say they see the price of a stock rising and they expect it to keep rising in the near future. They buy the stock for no other reason than that its price has increased recently. As an informed investor, you should realize that this is not necessary. Just because the stock price has gone up recently does not mean that it will keep going up. In fact, what you should also realize is that it is not only recent prices that are important to understand how the stock's price behaves. It might have gone up in the last 3 months, but what about the last 6 months, last 1 year, or last 5 years? To understand whether the stock is a good investment and whether you are buying it at a good price, you should look at the full history of prices and the stock's fundamentals. It is possible that even after considering the stock holistically and thinking carefully about the decision to buy a stock, you come to the same conclusion that you expect the price to rise. That is okay. At least after thinking about the investment holistically, you will be making an informed decision. This bias is also closely related to another important phenomena in markets, which is attention. Are you consistently only paying attention to stocks that have risen in price recently or those that have hit 52-week highs because you get notifications about these stocks from your broker or a news app on your phone, or because these are the first things that you see on your broker's platform? If this is the case, then you might only be considering these attention-grabbing stocks in your investment decisions and ignoring stocks that have lower everyday price movements but are better overall. If you feel like this might be happening to you, perhaps it might be a good idea to turn off these notifications or to change brokers. Overall, it might be difficult to understand and admit your own biases, but it can definitely reduce your investing mistakes and make you richer over time. I wish you all the best in your investing journey.